NIO stock was somewhat crashing on Friday, August 28th. Is it time to bail? Run for the doors? Let's discuss. Time and time again, I see people all over the internet spewing doubt about this company, saying that they are doomed, shares will drop to zero, bankruptcy is just over the horizon, and time again, I see this company prove them wrong, outperform expectations, and continue moving in the right direction. Whatever happened to the long-term investor? Let's not forget that this is a startup electric vehicle manufacturer growth company. There are going to be hiccups, there are going to be obstacles, dips in the road. And yet again, investors ran for the doors as NIO announced a share dilution. Share dilutions. What is it? Why do companies perform them? What does it mean for investors? And what are the long-term effects? Shares of NIO dropped almost 7%, down to $18.50 USD per share, down from a close the previous day of $19.88. This is a loss of $1.38. Now, this is actually a relatively large single-day hit. So why did this happen? And what does it mean for investors long term? Is it time to bail, or is it time to add additional stock? If you haven't already, please hit that subscribe button, hit the like button, demolish that bad boy. I don't currently have the same lens I had, so for the time being, you're not going to have to look at my ugly mug. I didn't want to stop making videos. I feel obliged to keep my subscribers in the loop and informed. So NIO announced a proposed offering of 75 million ADS with a grant to the underwriters, or the people who actually complete the transactions, to purchase an additional 11.250 million shares. When a company increases the quantity of shares in the open market, this means the value of the pre-existing shares proportionally decreases. You can think of it kind of like the supply-demand of money in the market. Money's worth is correlated to the amount of money circulating within the market. When you hear about the Fed printing more money, inflation goes up, and available money is immediately worth less because there's more of it, decreasing the value of each dollar. This is a similar concept for when a company secretes additional shares into the market, the worth of each share is slightly minimized. So is this a bad thing? Well, to be honest, it's not the most favorable for investors in the short term. As an investor, the best case dream scenario would be to buy in early to a growth company and have those shares literally never dilute. Therefore, the worth per share would technically only increase as the value of the company increased. However, this is almost never the case. Dilution is to be more than expected when investing in a young growth company. It's practically guaranteed. As an investor of a growth company, you should factor this into the future share price. Diluting shares is one of the primary ways a growth company can generate capital in order to fund additional R&D, expansion opportunities, and to actually develop their products. Because NIO in this particular dilution has injected 75 million shares into the open market at 20.44 per ADS, this results in $1.553 billion of additional capital. Before the offering, there were just north of 1 billion shares, 1.055 billion. Therefore, this offering resulted in a 7.11% dilution per share, plus or minus the optional 11.250 million underwriting shares. Now, other growth companies and other EV growth companies have done similar diluting practices in the past. Let's look at Tesla's history of injecting shares into the market. We can see that they have diluted their shares up to 10%. And in case you haven't heard, they're doing pretty good. So why exactly has NIO performed this share offering? Well, for one thing, they are doing it to raise additional capital to even further better position themselves and to relay to investors that they are continuing to grow, continuing to expand, and hopefully prepping for a European launch by the second half of next year. If you have any experience with investing in new growth companies and pay attention to the details, you would have undoubtedly been invested in a company that has gone through share dilution. I can guarantee it. Another important note is that this will not be the last time NIO dilutes their shares, and here's exactly why. NIO ADR is the American holding company of NIO China. NIO ADR sold about 24.1% of their stake in the company to local authorities and investors within the Chinese government based in Hefei province. This transaction essentially saved NIO at the time in 2019, as cash on hand for NIO was extremely limited and they were virtually days or weeks away from bankruptcy. As part of this agreement with NIO China, NIO ADR is obliged to transfer 600 million USD within several tranches. They have already performed 2 tranches of 182 million each. Tweet it out now. Li Bin is a confirmed Blink-182 fan. Hashtag Li Bin Blink-182 fanboy. Hashtag Dude Ranch or Bust. After these 2 tranches, there is still a balance owing of 236 million, which means that NIO will have to perform more tranches, with the next expected in September. It is extremely likely that there will be share dilution to essentially purchase back the company from NIO China. Because Li Bin's personal wealth and investors' interests are correlated solely within NIO ADR, or the American counterpart, it benefits both him and investors if he buys back ownership from NIO China, increasing NIO ADR's stake within the company. As Li Bin and NIO ADR purchases back more shares of the company, future profits would be more concentrated into NIO ADR, Li Bin, and investors' pockets, and less for NIO China. This buyback timing itself is quite unusual, as the company is still not profitable, and it would have been much more typical for the company to purchase back shares after reaching profitability. So why exactly is Li Bin doing this now? Purchasing back NIO China shows that Li Bin and NIO ADR wants the company back. They are buying back ownership before either company is worth a very high valuation, essentially meaning that buying back the shares that NIO China owns at a cheaper price than what it may be in the coming years. Although I thought this would only happen once NIO is completely out of the woods, it is somewhat a bold move from CEO Li Bin, as he's doing this very early on, showing his personal belief in the future of this company. This may show that he really believes in the company's future health and that he wants the stake of the company back because his own wealth and investors' interests lie solely within the 75% ownership that NIO ADR owns. More stake directly equates to a higher proportion of profits going to shareholders in Li Bin's bank account. Not waiting until profitability is a somewhat short-term gamble. However, the long-term potential of doing this early on rather than playing it safe and waiting is enormous. But how much of the NIO China will be purchased back by NIO ADR? It's probable that they won't buy back the entire company or the 25% stake that the Hefei government owns. And let's think about this for a second. Why is this? It's actually more beneficial for NIO to have partners who also rely on NIO's success. Look at what NIO China has done for this company. They were on the verge of bankruptcy prior to this agreement and could have filed literally any second, and this agreement with the local authorities and investors completely saved NIO. It's essentially a life raft in stormy seas. Now that the company has been trending in the right direction and recovering very nicely, the local government and authorities based in Hefei want NIO to continue to succeed and will actively promote and help NIO if need be. If NIO yet again gets into stormy seas, I would not be surprised to see another cash injection from these authorities. Although this would not be ideal for a number of reasons, it would mean that the share price would not go to zero. So as an investor, I'm actually more comfortable investing in this company, knowing that NIO has additional backing from Chinese governments that directly benefit from NIO's success. I would not be surprised to see the share price dip back down to around the $18 mark. However, we do need additional data points to see where the support line will land. We can be sure of one thing: this will not be the last time NIO dilutes their shares, but as I've said, this is to be expected. I would not be surprised if they raise over $2 billion, maybe even $2.5 billion, until they are able to begin generating profit on their own. The important concept here is that if you really want to reap the rewards of a company, you need to put trust in the company, their business operations, their ability to grow, so you pay the short-term price of share dilution for the hope in the coming years that they will be able to generate their own money, at which point we can hope the share price will raise in an undiluted and hopefully exponential fashion. NIO has been recovering extremely well. They have reached higher share price targets, their share price continues to increase, Li Bin wants ownership back, he's buying back shares from NIO China. NIO has released public intent to go global in the second half of 2021, and they need US dollars to do this. The best way to do this is to release ADS into the market, gain capital, and then attempt to expand as fast as possible, reaching profitability in the coming years. To summarize, although dilution is not great for a shareholder in the short term, the long-term potential remains great for this company. It is completely to be expected in startup growth companies, and it will not be the last time it happens. Therefore, if you are planning on investing within this company, do not be surprised to see other days in the near future where there is maybe a 5, 6, 7% pullback within the course of the trading day. Volatility can be your friend long term, and it's important to harness these windows of opportunity if they present to you for long-term gains. This is what you are buying into when you buy a growth company, and remember, no stock is ever risk-free, especially a Chinese EV manufacturer startup with a holding company based in the Cayman Islands. That sentence alone gave me goosebumps, but hey, I believe in them long term. I'm more than willing to assume the risk, but make sure to come to your own conclusions, do your due diligence, do your homework, and formulate your own opinions. Anyways, thanks so much for watching. Hit that subscribe button. I'll have many videos like this, actually with a lens in the coming days. Anyways, thanks for watching, guys. I'll see you guys next time. Take care. Cheers.